Good morning. The Bank of China is one of the largest banks in the world, the fourth largest. BOC is different from the PBOC, the People's Bank of China, which is their central bank. Bank of China has operations in over 60 countries, and BOC's bank in New York is one of their primary clearing banks for renminbi. So this bank in New York is a key part of China's offshore renminbi market. It manages a conversion of currencies back and forth between US dollars mainly and the Chinese currency. So as China's exports boom to the rest of the world, this is one of the main banks charged with taking this $1 trillion equivalent from countries across the world and converting them into RMB. Researchers from this bank, the Bank of China, published a report of their recommendations to the People's Bank of China and to other regulators here. They want to reduce even further their exposure to US dollars. The national debt in the United States keeps going higher, setting records. US Treasury bonds are not in default, technically, yet, but things cannot keep going the way they are without something breaking. The American economy cannot outgrow the problem. Debt is rising far faster than any growth anyone thinks we'll see. The certainty of rising US debt and trade deficits and the uncertainty of tariff rules have resulted in a crisis of credibility. So these executives at the Bank of China are calling for more selling of US Treasuries and for more buying of gold and other commodities. China is doing that already, but the Bank of China is recommending they go faster. US Treasury holdings are at the lowest level in 16 years, going back to 2009. For gold, China is already the world's top miner of gold, and they're also buying record volumes of gold on foreign exchanges and hauling it back to vaults here in Asia and in vaults of their biggest trading partners. So that's all from Bank of China. Morgan Stanley is a US investment bank, and they come to the same conclusions about the US dollar. The dollar just saw its biggest drop in over 50 years, and MS says that will continue, dropping another 10% by the end of next year. Foreign investors will have little choice but to hedge their exposure to US dollar assets, which will drive further declines. Looking at this chart again, the only down arrow, the light purple, is China. All those other arrows are up. Japan, it's off its high, and they may be outright sellers going forward, but UK, Canada, and the offshore money center banks are buying more. Morgan Stanley is saying here that over half of these bond holdings from Europe are not protected against a decline in the value of the US dollar or in their bond holdings. When yields go up, and they are, the market value of their bonds goes down. What's more, the US dollar is also falling in value. So the interest payments these investors receive are worth less today than when they loaned the money. If the USD strengthens, goes back up, this is not a problem. But if it goes down another 10% by next December, these lenders need a new strategy, and that means buying options before the others do. But the end result is even further declines, this time from hedging activity. So China has already gotten out of the way, and the falling dollar isn't nearly the problem that the others have, especially in proportion to China's trade surpluses. Goldman Sachs is another US investment bank, and they point out that China's economy is growing much faster than they thought it would be. And that is another macro factor driving US dollar selling. The People's Bank of China carefully manages the exchange rate, which is currently the highest since last November. The Shanghai Stock Index is today at its highest level in over 10 years, since August 2015. This is the year-to-date chart, yet another chart where it's hard to see just where exactly our trade war is hurting the Chinese economy. Bloomberg says the stock market rally this time is different from previous bull markets here in 2008 and 2015 because interest rates in China are much lower today compared to then. So a lot of this money going into the stock market is long-term money and not from short-term speculators. So if Bloomberg is right and China's stock markets keep driving higher, that will be another factor that will drive the conversion of foreign currencies back into renminbi to fuel domestic investment here. The research report from Bank of China also called for increased purchases of key resources and strategic materials. The secret is out now. China has monopolies on rare earth metals and particularly the refining of all those. China also enjoys massive supply chain advantages over lots of other raw materials inputs crucial for manufacturing. That has resulted in real-world impacts that few people foresaw a year ago. Now, NATO defense contractors can't build weapons, and factories in the G7 can't get raw materials they need to make products that compete against factories here. The Bank of China is saying here that Beijing should keep doing exactly what they have been, but faster and more of it. Continue selling treasuries, continue buying gold, and continue Belt and Road Initiative investments to lock down supply chains for everything their customers in the industrial sectors need. They do that, and these giant trade surpluses and exports, they will also continue. These are the Altai mountains in Inner Mongolia. Be good.
Knock, and it will be open to you. Everyone who asks receives. He who seeks finds. And to him who knocks, it will be open. Jesus said, I am the way, the truth, and the life.